Hi, and welcome to Financial Detox. I'm Jason Labrum. It is what month are we in, Alex? It's
April 24th today.
Mid-April, almost end of
Spring.
April, mid-April. We're running a Financial Detox show today. Myself, Jason Labrum, your host, and
Alex Klingensmith.
Alex Klingensmith, the president of IDA and the best co-host on the earth of any podcast.
That's a big statement. I think we need to explore more of the world then, if that's where we're at. This is all we're maybe the best financial detox podcast.
Self-prescribed title and designation.
That's funny. That's funny.
Thank you. On All In, the greatest. He calls himself the greatest moderator ever, Jason. He's not the greatest moderator.
You can say that, though. There's subjective anyway, so it's your opinion only.
Is subjective.
Kind of like investing to some degree, right? Investing can be deemed subjective. It's opinion based, and you don't know if you're right or wrong until it's over, right?
Yes. What are we talking about today, Alex? What's the plan, man?
Well, last month we talked about the election. I think we probably continue to talk about that a little bit throughout the year until it's over, because people are going to keep thinking about it more and more. But I think more important is going to be the biggest mistakes people make as an investor, right?
We're going to hit 3 mistakes that you do not want to make. There's people who don't have the right advisor helping them with their wealth management and investment management, portfolio management, that are going to make these right now, because this is the present and pretty continual stuff we're hearing from clients and people about their concerns and, what's going on, which makes tons of sense, right? People have concerns. They're reasonable. They're thoughtful. They're real. And we need to acknowledge them and then acknowledge how to handle them, how to deal with it, right?
And we have real data to support statements we're going to make today, right? So that it's not just opinion-based. Actually, it's data-based. There's a really good study that we used to reference all the time, and I think we should probably dust that thing off and get the newest version. And for maybe the next show is the Dalbar study, right? Because that evidence is the investor returns when they do it themselves versus with professionals. So then even deeper into that is what kind of professional. Is it a fiduciary all the time, or fiduciary some of the time, or an insurance salesperson that's acting as an advisor? Anyways, that's another show topic probably, but I think it's good to see what history has to say and show us how we can avoid those mistakes, right?
I believe you're totally correct in that. And you have to look to history. One of the things we also recognize is that looking to history is awesome and understanding what happens in the past, but that is not necessarily a perfect indicator of what's going to happen in the future, because things do change, right? And there are paradigm shifts. We're dealing with what we think are some serious paradigm shifts in the marketplace and how to invest money, and making sure that we implement those into our clients' portfolios, because there are things that are changing. As an example, you look at small cap stocks. There used to be a proliferation of small cap stocks that would end up going IPO, and that's how they got capital and how they grew to the next phase and had a big capital event. And what's happening in today's investment world and society is that these companies are staying private longer because they're able to get money from private equity. So they don't go to the public markets. Therefore, all that explosive growth that happens in the early stage of a company hitting profitability and expanding and growing is not happening in the public markets. It's happening in the private markets. So there's a lot of things that change. And so let's dive into it. We had one, Alex, that we felt was pretty critical to hit right off today to talk about, which is one of the most basic premises of investing that's been around for hundreds of years, which is asset allocation, right? How should I allocate my money? Because there are so many different places to put it, and there's so many great marketing stories vying for your attention and vying for your assets. How do I decide to allocate my money? That's really, when you look at, I'm going to take a pot of money and I'm going to invest it for some objective, whatever your personal objective is, where am I going to put it? That's kind of the first question. Do I want to buy stocks? Do I want to buy bonds? Do I want it to be in money market or cash alternatives such as CDs or money market funds? Do I want to buy private investments like real estate or maybe private equity or private credit or infrastructure? All these questions, that alone is enough to stump most people and leave them bewildered, especially if you start looking at the news or reading about how you should allocate, because there's probably somewhere around a couple million different opinions on where you should put your money. So how do you figure even that out, which is a pretty basic thing, right? Is asset allocation, but yet it's also very complex.
Yeah. I remember, gosh, when we first started working together back in 2012, I remember one of the first, maybe second events, remember the one at the library, the Carlsbad Library, you had a big giant group of people and we were supposed to be talking about taxes, and somehow the conversation shifted.
Oh, right.
And you did this talk many times, but you put up a picture of the world, right? You're like, where do publicly traded goods and services exist? Where can you actually harness growth as an investor? Where can you make money?
Yeah.
And then you show like remember the map, I think it was Dimensionals data, but it was like, it shows a map of the world. And then by percentage of how many companies of publicly traded stocks exist across the world and where do they exist? And then the same thing for bonds. And that was a good starting point, I think, for people to really grasp that it's a big world out there. It's not just only the S&P 500. That was the first. And then we used to have the funny joke where you'd be like, the market, well, what did you used to say? And you got people chanting along.
Trying to get people to understand that the S&P 500 is not the market.
Yes.
Right? Because everybody goes, I'm invested in the market. And like, what are you talking about? What does the market mean? What is that?
Yeah. And then you proceed to teach people about the different asset classes, right? That was the idea, I think. And it was a really good starting point for most people to just grasp that first. And it can be preference based. You can say, look, I love our country though. And our country is the one that I trust the most. As imperfect as it is, there's, I still don't trust a lot of these emerging market countries that don't transparently report what they're supposed to in terms of GAAP accounting. And I don't trust even international companies because they might not actually be doing the things the way we do them. And most US companies that are like gigantic are doing business overseas. So I'm still getting that global exposure through US domiciled companies, right? So that's important to probably factor into how, whoa, look at all these colors. This is what we
threw up the quilt. We got the quilt here. Well, this is our asset class performance chart. It goes back to 2013. What's crazy is if you take this back to 1950, 60, 70, it's similar. And I think the premise that you can draw from this, then this is showing different asset classes like, U.S. growth stocks, the S&P 500, U.S. value stocks, 60-40 portfolio, U.S. small cap, real estate, world stocks, not counting U.S., all stocks outside of the U.S., emerging market stocks, muni bonds, aggregate bonds, U.S. treasuries, and commodities. Those are all the asset classes on there. Yeah, lots of them on. So different asset classes. What's crazy is these are also, this is missing very, very important asset classes like private equity, private credit, infrastructure. Maybe you've heard of the old statement, the 60-40 portfolio is dead. And we think it is partially dead because there are other asset classes and ways to invest nowadays that you couldn't 10 or 15 years ago that can potentially add for compliance, that can potentially add measurable reduction of volatility and potentially add increased returns by incorporating asset classes that really weren't available, not too many years ago. And now they've become more available to regular investors with $1 million, $2 million, $500,000, $5 million, $10 million, where it used to be reserved for the ultra high net worth and or institutions. So what you derive from this, Alex, is we're looking at here and you see there's really no consistent pattern. I can't lay out, even algorithmically, you couldn't draw a pattern from this to say, well, I know I should invest in U.S. growth on these years and I should invest in value on these other years. As you can see, they're all kind of all over the board. I wish this was a bigger time frame too, because when you go back to the early 2000s, you see this U.S. value, which is not even in the top spot, not even once in this period. But if you go back to 10 or 20 years before, it's in the top spot.
I do like how they've kind of tricked you with data to show you the quarters of last year. And also the year of last year. I think that's what it is, right? Q1 of this year and then Q's 3, 4,
yes.
2, 3, 4.
So,
okay, I got one for you, Jason. This is the first mistake. Remember, this show's about mistakes. Maybe not the biggest mistakes, but some of the mistakes investors make. So let's say this is a person that's listening to this and looking at the screen and saying, well, I fired my advisor 2 years ago because they sucked. And you're like, well, so 2022 was terrible. I fired my advisor because they picked the wrong color, the asset class, right? Well, why didn't they put everything in the one that went up 26%? What was that? Commodities. What's the response to that? Like, how do we help people avoid that mistake? Because I know there's people listening that did that last in 2022 or 2023. They fired them because of 2022's performance, right?
Something I've seen repeatedly, Alex, 27 years of helping clients manage portfolios and stuff, is you see people associate how well their advisor is doing mistakenly to a particular time frame. My advisor did really well. My advisor is doing well without looking at how the markets did in relation. And notice I said markets, not market, because when I look at my phone, I see the Dow Jones, I see the NASDAQ, I see the S&P 500. Well, is that the market, or is that a really small piece of the market? I mean, if you take the S&P 500, that's 500 stocks. If you take the Dow Jones Industrial Average, that's 30 stocks. If you take the NASDAQ 100, that's 100. Add it all up, you're still at only 630 stocks. Well, just in the United States alone, there's over 4,000 publicly traded stocks, right? So this is tricky. So is that the market? Even if you looked at all three of those indexes,
a difficult
really
person would say it's a pretty big piece of the market, though, not by number of companies, but by the size of those companies. Perhaps you could say the market cap of those companies adds up to a lot. And I'm not trying to be difficult, but we hear this from people. We hear this from advisors and their clients, and our advisors and their clients. And then when we get a chance to actually sit down with clients, you and I, you hear it all the time. So I think it's really important to accept that and be like, you know what? Okay, it is a big part of the market cap and they have influence. These big companies have influence. But gosh, isn't it nice to participate in the smaller companies that have so much room for growth? Wouldn't that also be exciting too, right?
If you look back to 2013 and you look to 16 and you look to 2020 and even fourth quarter of 23 and second quarter of 23, small cap stocks are, the best performer or one of the top couple performers. So by leaving that out of a portfolio, you take a risk of being concentrated, you take a risk of not being diversified, not reducing the volatility, and potentially not getting as good a return. So, I mean, yes, it's not the right way to probably do it. There is definitely a paradigm shift, I think, where you look at U.S. large cap growth and you have to start to wonder, as these gigantic companies that have so much discretionary cash and free cash flow, are they almost private equity firms in and of themselves? Are they almost diversified investments in and of themselves because they're able to acquire any new innovation and ingenuity in the marketplace and competitors? They can pretty much swoop up whatever they want because they have unlimited cash. So it's an interesting dichotomy and conversation, but I think what will prove to be true over long periods of time is that you probably want to have some diversification and have a good asset allocation and understand why. The most important thing is your philosophy. Why do you have the allocation you have? And when you say the markets, what does that mean? Because when I think about the markets, I try to think about the markets as in all private stocks, all public stocks, all private bonds, all public bonds, infrastructure, real estate. That's the market, right? It's gigantic. So how am I going to go invest in that a way that optimizes that portfolio and gives me the most reward for the least amount of risk?
And then line it all up with your financial.
And that's what we're trying to do with asset allocation.
And then line it up with your personal, custom, emotional financial plan, your personal goals. Like how much money, where do you need to land on this chart on average every year so that you don't ever have to worry about running out of money and you can be free to do the things you want to do? And if the number is really, really high, then you have to be willing to accept that trade-off, right? If it's really high, if I need or want to make a lot of money every year, what am I willing to accept in terms of risk and volatility? What kind of emotions am I willing to deal with? Or if I'm like, no, I don't want to deal with that. I don't need to deal with that because my plan says I don't need to. Then what am I going to be realistic with myself and or my advisor? If my plan says I need 5 or 6% only, which is not a huge number, but I'm jealous of my friends that talk about all their crazy good returns in the NASDAQ last year or in Bitcoin or whatever. That doesn't seem like a fair trade-off. Like I don't want to have any risk, but I also want what they have. Like it doesn't work like that in real life. And I think what most people understand this, I think, when they really think about what they're saying out loud or feeling, but it's tough to disconnect, the emotions from the reality. I got a good one too. Another big mistake right now this year. And I'm anxious to see how you respond to this because I actually don't know what you're going to say. And I haven't been in one of your meetings for a long time with a client. I kind of miss it. It's really fun. Right now is one of these historic times in the as an investor or just as a person with any sort of liquid assets where money markets are paying 5.5%, right? So you can actually earn, and it's virtually guaranteed. I don't know if we're supposed to say the word guaranteed because it's backed by the faith of the U.S. government, which probably is pretty good.
Or the institution that's
it's like so people are looking at like online
fund,
savings accounts and bank accounts, and then the money markets are paying 5.2. My bonds have been negative or flat average annual return the past 3 or 4 years. Almost any bond, pick it, they're pretty much negative, right? You're mad at your advisor. You're mad at yourself. You're moving your money to money markets. Is it a mistake or is that a good decision to make right now?
It's really good. It's so interesting, right? Because when I started in this business, money markets were paying and cash alternatives were paying, 6%. When I was at Merrill Lynch back in the day, the CMA money market account was a 6%.
What year was that?
I am that old. A long time ago, more than 20 years ago, 25 years ago. But you literally would get 6%, and it was actually set up as a sweep account. So any dividends or interest would automatically sweep into that. Now all the investment institutions have changed that where it sweeps into something that pays no interest, and you have to actually go buy their money market fund, which has a little higher internal expense ratio so they can actually make money. But it was 6%. And then I watched that through the early years of my career and the mid years of my career go to essentially zero. And now watched it turn around and go to 5.5 again, or 5 anyway. So the thing that I think is really important as an investor is you have to realize that that can go back down. So if you're in a money market, it adjusts daily to what the current yield environment is. So you could be sitting here, I'm not saying this is going to happen, it's not a prediction, but in 3 or 6 months, and your money market, instead of paying 5 or 4.5, could be at 2.5. And what if that happens? Now you missed the opportunity to lock in that higher yield that you could have locked in by simply building a laddered bond portfolio, right? If I bought even treasuries and I laddered them from 0 to 10 years, I would have locked in today's yield for the average of that 0 to 10 year portfolio. Let's call it 5 years. So if interest rates went down, my bond prices would go up and I would look great, and I'd be collecting the higher interest.
Next to cause that. Not that we're predicting the future, but like, look about 20 years ago. What happened when you were just a little kid doing this 25 years ago?
The Fed starts cutting rates. There's a recession. There's tough times in the economy. Money supply needs to be tightened, which you could argue right now, given real estate prices, even at 7% mortgages, that has not slowed down the real estate prices. Now there's less real estate available. So there's other factors in that, but real estate is selling, at or above asking. It seems like the real estate prices are really strong, even despite higher interest rates.
A lot of people locked in these long-term low interest rates when they were available. And so there's not like a forced, people aren't forced to maybe move and rebuy it, restructure debt at higher interest rates. So it's okay.
Yeah, for now. But eventually you have all this money supply, right? And that causes inflation because there's lots of dollars. And we had all the COVID stimulus and PPP for businesses and personal loan forgiveness. And we're just pumping money into the economy and stuff. So that causes the price of things to go up. It makes dollars less valuable when there's lots of them. Like if you have, we talked about cars before we got on the show, right? If you have 6 cars or 10 cars or 100 cars available, they're less valuable to you. That's a bad analogy. But if there's tons of dollars floating around, they're less valuable. If there's only a few of them, they're more valuable. Gold is a good example. If there's not much gold, it's really valuable to have it. If there's tons of gold everywhere, if you could just walk out on the street and pick up bars of gold, then the price of gold would come down.
I think it's great for people to hear us how we think, because the things that we think, I think, are what other people are thinking, but we do this all day, every day with like lots of professionals. So hopefully that makes us experts on the topics that we're talking about today. But back to the
big hopefully.
I would argue that we are, but we're also human beings too, and we're flawed in that nature as well. Just doing the best that we can every day for our clients and for each other. But I suppose if you're that investor and you're trying to answer that question for yourself, like, I hate my bonds, I just want 5% guaranteed. Why would I not just move all that to the 5% until it starts to nudge down? And then the other thing is, what's the trade-off, right? So if I do that, And I don't listen to what you're saying about laddering the treasuries and laddering stuff. Yeah, there you go. Here's an answer to that question. Am I also missing out on upside for other asset classes like stocks or like private alternatives, like you mentioned, or like what do I do?
Yeah, well, let's just take a look. So if you look at some of the different markets, right? Some of the different markets, you have the S&P 500 has generated an average return of 10.4% since 1990. That's roughly the same if you go clear back to 1928. You look at small cap stocks as 9.21. Long-term bonds, this is something that most people don't realize because they've been terrible. 2022 was the worst year for bonds.
No wonder
ever
I don't like bonds
on
right
record.
now.
Ever.
Not just me.
Bonds did terrible. Right. And no, it's not just you. In 2023, they also did really poorly. And why did this happen? They did poorly because interest rates were going up, bond prices come down. If interest rates were zero and I owned a bunch of bonds in 2022, and all of a sudden interest rates go to 5%, how valuable are the bonds that I own that are only paying 1%? They're not valuable at all. Nobody wants them. So that's why bond prices have been so horrible. And just like most things in investing, right when they've done really bad and they seem like, well, those are terrible because everybody's basing that opinion on how what their experience has been the last 6 months, 12 months, a year, 2 years. That's about the
pretty
maximum
good even at that,
memory
man.
of the average investor, right? Is a year. Yeah. But so they think bonds are terrible, but right now, today, and historically, you look at bonds, long-term bonds, 5.7%, short-term bonds, almost 4%. So are bonds a bad investment today, even though they were not a great returning investment the last 2 years? I would argue they're not. They're probably,
on sale.
Probably. They are the best. Bonds are right now a better investment than they've been in the last 20 years.
Another mistake. Hold on. I love this because this is what we promised people at the beginning of the show. Another mistake is also to not have clear expectations around what you're buying and what it's supposed to do for you long term. So like what you just said, I think it's good to add on to that and say, they're on sale, they're a good deal, but what should the expectations be long term? Right there on the screen is what you should expect. You shouldn't expect them to all of a sudden be your best performing asset class for the rest of your life, right?
No, they won't be. I mean, bonds have less volatility, less perceived and less implied risk. Therefore, they would have a lower expected return. This is pretty simple from that regard. Hard. I mean, when you think about as an investor, should I hire an advisor? Well, probably. Most people probably should, but you got to hire the right one also, right? Because there's things like just we talked about the asset allocation. How do we get invested? Now we're talking about, all right, well, how much money do I put into asset classes? What about the fact that some of these asset classes look terrible for a couple of years, and right about when they look their worst or they feel the worst is probably when they're their best opportunity to invest. And that's just counterintuitive. That is not natural. So people make mistakes all the time by allowing the recency data to influence their decisions without looking at the bigger picture of what's really going on.
There's probably a really good psychology study on why people do that too. I bet you there's, if you, I mean, we've read books on this, right? The Psychology of Money and some of the book club books we've read. And maybe in human nature, if you look at other things that we tend to bet on, sports, for one example, a team that's pretty good, usually it's a good bet, probably, right? The worst team usually doesn't end up winning the Super Bowl in the next year, right? Stuff like this. Maybe we're just wired to bet on winners all the time and what we think is going to win.
Totally. I mean, we've been predisposed to that and programmed for that for our whole lives in everything we do as Americans and in society in general. You want to be part of a winning team. You want to be part of something that's good. So it's really hard to go say, I'm going to buy and invest in the worst asset class that's the last 2 years. And the fact of the matter is, people's memories are short. Ours are short. People's are short. And the bias towards recency is overwhelming and consequential, and it can cause you to make huge mistakes if you don't step outside of that bias towards recent data and look at the bigger picture. It's amazing looking at these charts and you look at what's happened to, it's $100,000 invested in 1990 has turned into $3 million if you invested in growth stocks, right? S&P growth stocks over the last 30-year time frame. 100,000 turns into 3 million. So investing works. It's supposed to be difficult though. It's not easy to pick an asset allocation, to stay disciplined, to avoid recency bias, to then reallocate that portfolio to maximize it for tax optimization. for tax efficiency. These things are not easy to do. They're really hard to do. And that's why you want somebody to probably help you. And we talked about this a little bit lately about our average advisor is just under 20 years, about 19 years of experience in the business at IDA Wealth. And we've got 30 plus years of advisors. There's so many things we've seen and experienced, and even mistakes, dozens of mistakes we've made as advisors, and hundreds of mistakes we've seen clients and other investors make during that tenure and that time giving advice, that is invaluable. Because if you think about the clients that choose to hire us, they are getting the benefit of not making those dozens or hundreds of mistakes that we've made and seen made, right? And that is real power, because this show is about not making mistakes when it comes to investing. And if you can avoid mistakes, then it's so profitable and so much easier to have success and have good outcomes in investing by just avoiding some of the big mistakes.
I think we're going to have to make this a two-parter maybe, huh?
We're going to have to try and make it a two-part. Let's plan on it next time. I think this is important stuff, right? I mean, at the core of what we do, Financial Detox, is to help educate consumers about making better investment decisions. We want you to be financially detoxified. That includes avoiding bad advice, because there's lots of bad advice out there. And it also includes managing your wealth for the best impact for your life. We don't believe money is the most important thing, but we do believe it sure can make the most important things in your life more enjoyable. And so what we want to do is help you maximize what you do with your money and build a financial plan around your investing strategy, understand why you're investing, have a philosophy, stick to it, and you'll have wildly successful outcomes. I mean, the last visual we threw up here, Alex, is just a little bit of staying invested in what happens. I mean, if you buy and hold the S&P 500, and we're using that as, that's not the market, that's just a piece of the market. We don't recommend you only buy the S&P 500, because you can do much better, we believe, by diversifying and having a broader asset allocation. But you buy this, you hold it, you have 10% return. If you move to cash at the bottom of the 2008 financial crisis for 1 year, your return has dropped down to 7.2%. If you move to cash at the bottom of the GFC and hold, you're negative 1%. You cannot time the market and get in and out. You just need to build a portfolio that is going to give you the journey that you can tolerate, that matches your financial plan.
We're a perfect person to talk to, a perfect team to talk to. And if you have an advisor, and your advisor, whenever you call them and you give them this hard conversation and they tell you something doesn't make sense, it's a good time to start looking for someone else, right? I think a good relationship with your advisor is one where you can be honest and they can respond with, you know what, that did suck, but here's why that still was the right thing to do. Because if you didn't do it that way, here's all the mistakes we could have made together. And then you should have fired me if I did all that stuff.
As soon as your advisor tells you they don't never make mistakes, and they didn't make mistakes, and they won't ever make mistakes in the future, and they can tell you what the market's going to do and help you get in and out, it's definitely time to run and hide. Seek fiduciary advice. That's somebody who's legally bound to act in your best interest. That's somebody who operates with an RIA and through an RIA, not through a broker dealer. We believe that gives you the best leg up to find somebody who's financial planning based, who's not product based, who's going to really seek to help you build a strategy so that you can succeed with your personal financial goals and objectives. That's what we do here at Financial Detox. You can check us out at financialdetox.com. You can send an email if you have a question or you want us to address a personal investment strategy for you. Send an email to Jason at financialdetox.com. That's my own email address. I check that every day so I can reply to you and will reply to you. And last but not least, if it's easier, you can give us a call at 866-707-8889.
877. I was going to say 866. And the email's always the best, man.
877. What is it?
Yeah.
Did I get it right?
You got to call yourself.
I remembered it. And then I did. Awesome. We want to thank you for tuning in. It's Financial Detox. Hope you enjoyed the show. Give us a like. Feel free to reach out. We're here to help you make better investment decisions, avoid toxic advice, and manage your wealth for maximum impact. I'm Jason Labrum, your host, and we will get you on the next show.